in corporate finance will typically look at two main balance sheet items when trying to decide if they should return capital. They will look at the company's cash balance and cash that's available for investing. They'll also look at the retained earnings of the business as well, although cash ultimately is more important than retained earnings since it's actually cash that's going to be returned to shareholders. The managers will have to look at future investments that they've already committed to and then decide if there's any excess cash available over and above those investments or operating expenses that they've already committed to fund. But assuming there is excess cash or excess retained earnings, then they'll follow the decision-making tree, where they will look at the internal rate of return of the investment and compare it to the WACC. And if it's more or less, then they decide what to do. So as a recap, if the internal rate of return is less than WACC, they have two choices. They can repurchase shares, which puts money back into the hands of the shareholders and takes it off the company's balance sheet. Or they can pay a dividend. If, however, we're on the other side of this decision tree, then it means there's a high enough rate of return that we should invest in that project. And the cash that's on the balance sheet gets used to fund the project.